accounting for government grants and disclosure for government assistance. So this video we are going to explain how are we going to treat government grant when we receive grant related to respective asset or expenditures in response to their each reference purpose. So in general, our government grant, we have two types of government grant. One is capital grant, which is meant for the purpose of capital expenditures, any things that you spend which will increase the capacity of the entities that will be considered as a capital expenditures, such as acquired, develop, construct of non-current asset. This is called capital expenditures. If the government give us grant in relations to all that capital expenditures, we are going to call that as capital grant. In contrast, if we are spending revenue expenditure, meaning to say normal operating expenses such as staff and training, and because we're spending this staff and training costs, government decided to give us the grant. This is called revenue grant. So each of these grant, you need to distinguish the differences, because after we have ascertained what type of grant it is actually fall into in these two categories, we will need to think of how are we going to treat this grant in our SOPL and SOFP. So generally, capital grant, we have two methods over here, IAS 20. One is net off against asset method, and another one is deferred income method. So let me just explain using an example in here. For example, if my cost is 1 million and I have a useful life of 10 years, you know that according to IAS 16, property, plants and equipment, PPE, we are going to depreciate over 10 years, and these 10 years, each year we are going to depreciate by 100k. I just give you another example whereby I incorporate residual value. So if I tell you that my residual value is 100k, to make the calculation simple, I changed my useful life to 9 years, and you will know our depreciations will be 1 million minus the residual value and divided by 9 years. Each year you are going to depreciate by 100k. So this is my depreciations. If we present it using IAS 16 PPE, the carrying amount, example, in year 1, especially 31st December, because we are calculating the full year depreciations, X6, and we are starting with the cost. And depreciations and carrying amount, and you will tell me that the cost is 1 million, depreciation is 100k, end up we are going to land it at 900k. Same things, we will depreciate accordingly in the second year end, which is 20x7, and we will depreciate accordingly with this 900k, and you are going to get 800k carrying amount at 2000x7. This is what you learn in IAS 16 PPE. However, when the grant is coming into the picture, assuming this is capital grant straight away, yes, we know because this is on your non-current asset, and the grant amount is 20% on cost. So we are going to calculate 1 million times 20%, you will get 200k, that is your grant amount. And how are we going to treat this grant calculations in our financial statement? So this first method that I'm showing you here, we are doing capital grant that is based on net off against asset method. So let's see how are we going to do this method. So for net off against asset method, whenever we have a grant, assuming we haven't get this PPE yet, so we are assuming them happen in the same period, and before we calculate the depreciations, still the same example, cost is 1 million, residual value 100k, useful life 9 years, and the grant is 200k. So we are going to definitely, when we have this asset, we will debit our PPE, credit our bank, as what you can see in here. Debit PPE, credit bank. We buy this PPE for 1 million and 1 million, like what you see in here. But when we receive grant, how are we going to treat this? According to net off against asset method, we will use this benefit is like a discount minus the cost of your asset. This will happen by debit bank and credit your PPE. So we will debit bank 200k, credit PPE 200k. Is treated like a discount on the PPE or rebate on the PPE. And therefore, when we calculate our costs in here, we will need to minus the grant first. So we will minus the grant and the cost after the grant, net costs 1 million minus 200k. We know we are going to start at 800, and this is the amount that we are going to so-called depreciate over the 9 years. So meaning to say that 1 million minus the 100k, 800k is the revised cost after the grant minus 100k. In simply terms, we can present in here and divided by 9 years. Because our cost now is 800k after we minus the grant, 800k, and we will minus the 100,000 residual value only divided by 9 years. So in this case, 800k minus your residual value and divided by 9 years, you will get 77,778,000. So this will be your annual depreciations. Then we will depreciate accordingly, and we will depreciate accordingly, and this will be your carrying amount. So this is net off against asset method. So we straight away treat this grant as a discount or rebate to reduce the cost, and we depreciate based on the cost after the grant. And initial measurements of grant, your debit bank, credit PPE. So as you can see, this credit PPE is the reductions of the cost of PPE. That's why based on this revised cost of PPE, after you minus your residual value divided your useful life, you will depreciate accordingly in SOPL. And meaning to say, this depreciation already taken into account the benefit of grant already. Then you depreciate until the useful life end. Here we don't have release of grant, because the release of grant will be applied for deferred income method. And now let's do deferred income method. So deferred income method doesn't lump this grant in your cost. If we are talking about IAS 20 capital grant, but we are using deferred income method, this will be something different because you need to maintain separate account called deferred income liability. And to do this, assuming our example still the same and grant is 200k, so first thing first, we will need to calculate our cost IAS 16 PPE. The cost here still 1 million, and the depreciations here won't change. We won't minus the grant on this cost. We will use 1 million minus 100k and divided by 9 years. And with this, we are going to get 100k depreciations and we depreciate accordingly. 900,000, and this is for 31st December 20x6. What about 20x7? You will depreciate accordingly the same, and 800k carrying amount. So from these particular steps, you know grant is not involved in these calculations. But for IAS 20 deferred income method, this grant will be recorded, or we so-called temporarily parking in your deferred income liability account by debit bank when we receive and credit deferred income liability account. 200k, 200k. And this liability, as you know, is actually like your unearned revenue. Unearned revenue means what? When you are actually collecting the money from your customer, but you service them later. So when you receive the money first, you are going to debit bank, credit unearned revenue as a liability. And when you perform the task already, you are going to debit your deferred income liability to make your liability reduce, and you credit your revenue. This is for matching purpose. And we are doing this for the same purpose as well. We want to match with the depreciation happen date. So deferred income liability, we will gradually release out. When you release, we will debit deferred income liability and credit your income under SOPL. But now, let's don't focus on this. We will need to maintain a separate schedule called IAS 20 deferred income liability to actually see it clearer on how is the movement. So on 31st December 20x6, the grant amount will be start at 200k. And the following calculations very important, because to derive at 31st December how much is your carrying amount of your grant, you will need to see how much is the grant that you want to release in SOPL under your income. And this will depend on your depreciations in the year. You are going to depreciate 900k over 9 years. So assuming now I give you a timeline. You have 1, 2, 3, 4, 5, 6, 7, 8, 9. So this is 9 different years. And I tell you, your 1 million minus 100k of residual value, you will get 900k, which is your cost after residual value, split it into 10, 9 useful life. That's why you divided by 9. 900k divided by 9, you will get 10,000, and this 10,000 you will gradually reduce under the depreciations. You will gradually reduce under the depreciations, and total your depreciation will be 900k. Total your depreciation will be 900k, and this is your depreciation. So the grant that we want to release out, the grant in total is 200k. The grant that we want to release out must be in proportionate of how much you have depreciated during that year. So the calculation is very simple, yeah. You will just need to calculate the percentage of depreciations you have made. 100k divided by total depreciations, meaning to say cost minus residual value. Over year 1, you have depreciated by 11%. Okay? And over year 2, 11%. So meaning to say, every year gradually reduce until the end of 9 years, you are going to depreciate by 100%. So this is every year you are going to depreciate by 11%. And based on this 11%, you actually can allocate this 200k and you will release 22,000 every year. And this 200k grant will be gradually released to SOPL as an income, and at the end, you will fully release 200. So in short, we will follow the proportions of depreciation claim over that year. Then this will be calculated by using the depreciation that we made in here, 100k this year, divided by your cost minus residual value. Cost 1 million minus residual value 100k, meaning to say 900,000, and only times with my grant, which is 200,000. And with this, you will get 22,000, and this 22,000 is something that you will need to gradually release into your SOPL. Bear in mind, your calculations in PPE is very important, because when this one is wrong, meaning to say this one is also wrong. So it's very important to make your calculations correct, because sometimes you are not buying full year. You need to depreciate based on time proportionate. Like for example, you buy in 1st of July and your year end is 31st December. So you need to times 6 divided by 12, something like that. If you didn't do that, you are going to wrong in here. And the next year, we are going to grant release same 22,000. And at the end of the year 20x7, our carrying amount will be 155,556. And this will be our deferred income liability at the end of the year. So when you present in SOPL, right, you will have a depreciations expense. You will have a depreciations expenses of 100k, and you have a grant income of 22k. So you are doing a matching. You match the expenses with the income, and this will be carried out in your non-current asset, and this will be carried out in your liability, but you need to segregate the liability into, for example, your SOFP. You have your example, this is a building at non-current asset, building at 900k, but the non-current liability of this, you will need to segregate into current and non-current, your deferred income liability. Next year, you are going to release all of, if you are standing in SOFP 31st December 20x6, right? As of 31st December 20x6, in this year, you have total liability 177,778. So this 177,778, 22,000 you will release next year. So it is a less than 12-month liability. Therefore, this is your current liability. And the remaining portions, which is 177 minus this 22,000, that will be your non-current liability. As you can see, is this number. Meaning to say, this is something that you are going to release after the next 12 months. So it's considered non-current liability. And this is something that you need to aware and take note when you are doing your IAS 20 deferred income liability method. So as you can see, the first method is very straightforward. You just need to put it under SOPL, under depreciations as 77,000, under SOFP, your NCA building as 1277k. So it's very simple if you are using net off method. If you are using deferred income liability method, will be complicated because you need to maintain a separate schedule to take part of to actually record this part. So this is for your deferred income method. Initial measurement, grant deferred income liability as a new account, and you will release the grant every year, you will depreciate every year. So this is for capital grant. if we are talking about revenue grant will be much more simple. We are talking about we are spending and expenses. And let's say we have incurred the expenses already. Incurred means not yet paid. It can be not yet paid, it can be paid, but we have actually made the expenses happen. So assuming we are talking about staff training expense, we will debit, example is 2,000, and I can credit bank if I paid already. If I haven't paid, I just credit accrued expenses for staff training, assuming I have paid 2,000. So the grant related to this expense, example, is 1,000. I need to debit my bank because I receive money 1,000, and I will need to credit. I can credit staff training expense to offset my expenses. You need to put it in the credit, or you can actually credit into other income. So you can choose whichever you want. But if let's say your expenses not yet incurred, meaning to say you haven't paid, you haven't incurred, everything not yet happened, but you already received the grant from the customer, from the government already. Grant related to expenses you receive already. So since you receive already, you need to debit bank. And where you need to credit? You cannot credit into SOPL. You will need to credit into deferred income liability grant account. You just put it under SOFP first. Don't hit into SOPL until you incurred already. Then only you debit. You reverse the debit. You reverse by debit deferred income liability, and this is the time you can credit your staff training expense and other income when you have incurred. So this is what it means for this part. When you incurred, you reverse your deferred income liability. So this will be the short summary of your government grant, and I hope you learned something from IAS 20. And thank you so much.